Hello and welcome back to No Pants Profits. This is Richard with another Robinhood IPO that just popped up in my app today. I have just pulled up the S1 form, have not even looked at it yet. Took a very brief look at what this company does, but let's get right into it. Let's take a look at Allbirds, which is a new IPO that's expected to IPO Next Wednesday is the expected IPO. It's going to IPO between $12 and $14 a share. I'm going to turn off my alarm there. It's going to IPO between $12 and $14 a share right there. So it's an interesting space for the IPO. Let's just get us on Do Not Disturb because we're off sleep mode now. All right, perfect. So interesting place for the IPO. They seem to be an apparel retailer. So guess what? It's time to dive into their S1 because it's not a SPAC. They are coming directly to market and see if it's going to be a buy from me, dog. So let's take a look at their website first. It's called Allbirds. The symbol is going to be bird. Don't let that confuse you with the scooter company bird. This is a completely different bird here. So let's go ahead. We're looking at their website. I do have the S1 pulled up, but it looks to be men's and women's, and they primarily make shoes. That seems to be the primary thing. Running shoes, water repellent shoes. Seems to be what's going on there. Wool dasher mitzels. I don't know what the heck that means. I personally wear Brooks shoes, which are kind of running shoes that kind of get your feet in line. So I am not an understanding of what goes on here. But let's see, men's new arrivals, women's new arrivals. Do they have stores? They do have stores. Not many stores. You've got San Francisco, San Francisco, San Francisco, San Francisco, New York City, LA, Pasadena, Century City is in California, San Diego, Chicago, Austin, Seattle, okay, Cambridge, Washington, Philadelphia, Minneapolis, Denver, Boulder, Atlanta. I'm seeing if there's anything down here in South Florida I can take a look at. London, Amsterdam. Nope, all of the rest of them look very international in nature. So let's go ahead, let's pop into my favorite form, which is the S1 form. Now, this is a specific document that's filed with the SEC, likely filed with the SEC today. What I'm willing to say was filed this morning. We'll see in a little bit. But this tells you everything about the company. So its name is Allbirds, and the symbol is BIRD. Again, not the scooter company bird, but ALLBIRDS. They are based in San Francisco, California. So this is where they're sending the copies to. Let's see who's involved here. They are issuing a proposed offering price of $100 million in stocks. Allbirds. Initial public offering. Again, we're looking for numbers, nothing else. Let's see who's involved. Who's the underwriter? JP Morgan, Bank of America, Morgan Stanley. They got a lot of big people involved here. Allbirds. What is this company? We know they make shoes. Better things in a better way applies not only to our products, but everything we do. That's why we're pioneering the first sustainable public equity offering. Bullshit. But okay, we'll go on. Better things in a better way. Kind of looks like a Lululemon, how they're positioning themselves. Made from nature for nature. Again, all we really care about is numbers here. But let's look at the presentation. World's most comfortable shoe, according to Time. I was wondering. I'm like, who said world's most comfortable shoe? Seems to be according to Time Magazine, 2016. Certified B Corporation, profitable, 100% of all cohorts have contributed. Company operated stores, so they got 27 stores in 35 countries, and they're reaching 2.5 billion customers. So, again, I've never heard of it. Our footwear averages 30% less carbon footprint than the standard pair of sneakers. So, again, very much like Vita Coco. If you remember Vita Coco, they were going for the sustainable, trying to get the millennial on board perspective. Something we did talk about with Vita Coco was NPS, Net Promoter Score, and that's very important. That's a number. That's a number that really means something. It's an industry standard. What NPS means is it is essentially the ratio of people that rate you either a 9 or 10 out of 10 versus the ratio of people that rate you 1 through 6. So if you're going to rate a company a 9 or 10, you are what's called a promoter. Not only are you going to go to that company, but you are going to encourage others to go to it. If you're going to rate it about a 7 or an 8, sometimes a 6. But if you're going to rate a company about a 7 or 8, sometimes a 6, you're going to be happy, you'll like your company and everything like that, but you're not really going to bring others on. You're not going to be a net promoter. And then if you're rating it 1 through 6, generally, you're what's known as a detractor. So that takes away from the 9s and 10s. Table of contents. Let's see. I just want to see if they make money. We make things in a better way through nature. Products that people feel good in and feel good about. We aim to reverse climate change through better business, empowering people to make better, more conscious decisions for themselves as well as the planet. We also want to make profit for our shareholders. Remember, number one thing for any public company is shareholder wealth. Shareholder wealth, shareholder wealth, shareholder wealth is number one. Allbirds is a global lifestyle brand that innovates and naturally derived materials to make better footwear and apparel in a better way while treading lighter on the planet. So that is what they're doing. When they founded Allbirds, they set out to create an all-purpose native company built upon a system that leverages nature in a responsible way. Again, nothing crazy there. But we're looking at numbers. Here we go. This is where it starts going into customer acquisition. These are numbers we like to see. Approximately 53% of our net sales in 2020 came from repeat customers. Important, which we define as customers who have made a prior purchase with us in any period. Furthermore, our U.S. customers acquired between 2016 and 2019, the average lifetime spend of the top 25% of each cohort is $446, demonstrating how our most loyal customers have made Allbirds part of their lifestyle. See section titled Market Industry and Other Data. All right, this is what we are looking for. Let's make that a little bit bigger if we can, while not going to another page. Oop. This is the part that I am interested in. Oh, we're hitting the minus button. All right. This is where it starts to get interesting. All right. Since our founding in 2015, so it's about a 6-year-old company, they grew net revenue from $126 million in 2018 to $219 million in 2020, representing a compound annual growth rate of 31.9%. Grew our digital revenue, 31% growth. Store footprint, 3 stores in 2018 to 22 in 2020. U.S. international revenue grew by $52.5 million and $40 million respectively. So an interesting space there. They generated I don't like that. Don't like that. So you can see they increased their gross margin, but this is where it gets bad. They don't make money. Generated net losses of $14.5 million and $25.9 million in 2019 and 2020 respectively. What do I expect to see lower down here? Well, everybody blames the illness for everything. So people were outside less, they weren't exercising as much, they weren't going to the gym, they didn't care what they wore. We can already predict what's going to be down here. Like I said, I just opened this up, just went public a few minutes. Well, this file just went public a few minutes ago. We stand at the intersection of changing industry and consumer trends. In 2020, our consumers spent $1.8 trillion on footwear and apparel, and $1.5 trillion on apparel, and $366 billion on footwear, with the U.S. portion of the total spending approximately $342 billion. Okay, lots of numbers don't mean anything. They're talking about the whole market. We want to know about their section of the market. Again, they're really going hard on the environmental aspect. How we and our customers are reducing the environmental impact of our footwear and apparel industry. So we've got that, and why we've been successful so far. Product innovation based on materials, R&D, simple and purposeful design. So we've got all that product innovation based on materials, research and development, and everything like that. So We've got that product innovation based on those, and that is a useful fact. Purpose-driven lifestyle brand. Again, they're losing money. I don't care how much purpose you have. Your purpose is imaginary if you're losing as much money as you are. Again, generated net losses 14.5 million and 25.9 million. I don't care how clean, green, mean, seen, sheen. I don't care what the heck you are. If you're losing money, you can make up whatever BS you want about product innovation, R&D, deep connection with our community of customers. Again, they keep going back to this number. 53% of our net sales in 2020 came from repeat customers. Global vertical retail distribution strategy. What that means is they own where they sell. So our digitally led vertical redistribution strategy combines our digital offerings with stores so you can meet consumers where they are, except if you're, in Florida, but they're in 35 countries across 27 store locations. So a digital footprint in a majority of those countries. And it allows them to generate approximately 98% of sales at full price for the entirety of our history. So if they're selling the shoes, then hey, if you take a look at someone like Apple stores are not everywhere. So they have to rely on Best Buy, they have to rely on Target and other places like that in order to actually sell their shoes. An example of benefits from our vertical retail distribution strategy, Boston Baybeck Shore receives standalone payback within 8 months. So they're saying they can pay their stores off very, 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 very quickly. That's what they're trying to say, but they're still not making money. Supply chain interface is advanced. Experienced, passionate team who believes in our vision. Again, why we will continue to be successful. You know what? I'm going to go back to it again. I hate to say it doesn't mean anything. The generated net losses, you not making money. I don't care how successful you think you are. If you're putting out generated net losses of 14.5 million and 25.9 million, you're not making money. I don't care what you're saying. Deep connection with our customers. Let's get back to where we were. Passionate, innovative, makes great new products, natural, sustainable materials. They're going really hard for green. I can't imagine the premium you're actually paying. They have, it's a clothing and shoe company with research and development. Our collaboration with natural fiber welding to commercialize a 100% plant-based leather alternative. Now, this could be an interesting pivot. Who knows? This company could eventually make pleather for car seats. It's kind of interesting. They want to make new materials. They want to expand footwear into other things. So our versatile, simple designs with hero materials allow us to expand our core product families. We plan to grow footwear sales by broadening, deepening our assortment across end uses, functional, casual, and occasional performance athletics, by also introducing new style, fit, size ranges to give customers more choices. So raise awareness and grow our customer community. Again, you're not profitable. You're not profitable. Increased product offerings provide more opportunities to buy greater breadth and meet wardrobe needs and more reasons to engage with us. You got to realize when you're making clothes and shoes, one of my favorite type of shoes is baby shoes, because baby shoes cost as much as adult shoes and use 1/10 of the material of adult shoes. So you're like, okay, why baby shoes cost so much? This should be pure profit. Expand their distribution method and meet customers where they are. Again, you'll look. So here's interesting. They're breaking down another number. Approximately 80% of orders are from repeat customers within the 6-month period. So we got that 50%. So really, they're only getting 20% of new customers every 6 months, which means their customer acquisition cost is very high. But they want to increase store fleet. You know what that is? That's a cost. That means you got to go into malls, you got to do build out, you got to do all those other things like that. Hey, look, let's blame our little friend. Remember our little friend we talked about 10 minutes ago? Based on our store's pre-COVID performance, we believe our new stores will be highly profitable, have attractive payback periods, serve as good capital investments, be positioned well to take advantage of physical retail's recovery from the pandemic. I'm not sure physical retail is recovering from the pandemic. Let me turn off this alarm here. I'm not sure physical retail is actually recovering from the pandemic because we have this thing called Amazon. further personalize and grow digital, competing with their retail storefront. Again, all this is all well and good, but do they make money? Here we go. Risk factor summaries. Everybody blames the COVID. The COVID-19 has had a material and may in the future continue to leave a material impact on our business. Economic uncertainty in key markets. If we're unable to maintain and enhance, they didn't make money in the pre-COVID days. They didn't make money in 2019. They lost more money in 2020 than they made in 2019. You buy this, you could be sitting with a bag. Climate change and increased focus by governments. So they're trying to say that their green mission is going to get them new customers, is going to get them tax write-offs. You know, our business maintains a way to get a strong community, and everything like that is what they are saying there. Our business depends on the ability to maintain a strong community. We're subject to risk related to environmental, social, and governance activities. Public benefit corporation. Hey, look, they're based in Delaware. Who would have thought? And it's a new class of corporations intended to produce a public benefit and operate in a responsibly sustainable manner. Doesn't matter. Don't make money. You know, it's a new thing. It's required to identify a certificate of incorporation, the public benefit or benefits it'll promote. Corporate information. We incorporated in Delaware in 2015, like most companies do. They are an emerging growth company, so they don't have to be audited nearly as much as the other ones. But remember, again, we go back to they don't make money. So let's see if there's anything else here. They're just talking about the number of shares they're going to be issuing. Here we go. Okay. So remember, they give us the full year of 2019, the full year of 2020, and the 6 months from the beginning of 2020 until June of 2021. That's what we're getting right now. Again, when we take out everything, weighted average shares used, loss. They've never made money since they've been publicly tracking this. Where are they losing their money? Operations, they're losing their money. Income tax, they're losing their money. It's just a pile of red. And if I'm looking, I'll scroll down a little bit so you can see. But it's just a pile of red. Consolidated balance sheet. Look at that deficit they've got. You know, total stockholders' equity, paid in capital. Yeah. Risk factors, again, let's blame COVID. You know, that's what all these companies do. Delays in delivery for products to our customers. Again, this is our first kind of retailer we're looking at in the IPO space, so they might all be putting this now. One factor of success is the strength of our brand. If we're unable to maintain and enhance the value and reputation of our brand, and counter any negative publicity, we may be unable to sell our products, which would harm our business and could materially adversely affect the financial contribution. Okay. Again, we have increased. Oh, look at this. It's almost like we saw this coming. Where was that? Let's zoom out a little bit. We rely on technical innovation. We have incurred significant net losses since inception and continue to and anticipate that we will continue to incur losses for the foreseeable future. Red light, red light, red light, stay away. We're not going to make any money. They're literally telling you not to invest in this company. I don't know how much clearer this can be. Do not invest in the... I'm not saying this. They're literally saying we're not going to make money. And understand, this ain't Tesla. This ain't Google. This ain't Amazon. This is a damn shoe company. You know, we operate in a highly competitive market. Remember, it's not a highly competitive market when they're talking about how much of a share they think they can take of that, you know, billions of dollars market. But it is a highly competitive market when we're talking about the risk factors. They've never turned a profit. They've never, if we fail to attract new customers, retain existing customers, maintain and increase sales, climate change focused by governments. Again, it's all going to break down. But again, I go back to this one phrase here. We have incurred significant net losses since inception and anticipate that we're not going to make money for a long damn time. You know, That's what's going on there. It's not something you want to get involved in. I'm looking if there's any more numbers here. We're going to go to Robinhood and we're going to make a final choice right here. Our financial results may be affected with substantial investments. Nothing new. Let's just see if we've got anything else here. And we're going to go over to Robinhood and we're going to place our order. We're going to talk about how the Robinhood IPO process works. I don't see anything else here that we the inability to acquire, maintain, use. Okay, they're talking about if they can't get their website. You think they'd have that lockdown? Subject to risk related to online payment methods. Fraud. Let's just see, is there any risk related to other regulatory? Again, a lot of this stuff is just standard stuff. United Kingdom's withdrawal from the EU may have an effect on global economic conditions, financial markets, and our business. Changes in tax law. I think I'm about ready to make the final call on this one. Let's just see. Let me make sure there's nothing else of any great value here. Charts, graphs, anything like that, but I don't think there is. Capitalization, okay. Again, cash and cash equivalents. They've got a bunch of not good money. They're not making money. They're literally saying, don't buy the stock. Oh, God. Oh, God, it's a damn Kickstarter. This is a Kickstarter that became a company that's never made money, so now they're begging the market for money. I wish I was making this up. Allbirds was a Kickstarter in January 2014. They raised $120,000 in the first 3 days. They're a Kickstarter. Well, they've done one thing. They've worked with Adidas on something. I'll give them that, but they've still never made money. Net sales, they're talking about growth, but they're spending too much on R&D and growing into new lines instead of taking the profit that they already have. You know, we look at this growth. Yeah, I agree there's growth. But if you remember, there's more loss as they grow. Yes, I understand for some companies that can be a good thing. Amazon, Tesla, you know, profitable with an initial month of purchase, a strong repeat rate, you know, 43% return, highly valuable multi-channel customers, increased spend upon return. So people are spending more money if they come back, they're spending more money. Yeah, that's a lot of red on this sheet right here. Here's all their losses. You know, they're losing 7.5%, 10.5%, 10%. So they're going to lose at least 20% this year, which will be slightly less than last year, but last year it was the illness. So people weren't leaving the house. People weren't wearing out their shoes. I think I wore I wore one pair of shoes for the whole lockdown. So again, I'm going to put this whole document below if you want to skim through it. But oh, look. Inflation risk. Ha ha! Who would have thunk it? Founder's letter. I don't see anything else here other than some jargon. Passionate team. We've already seen all this. We must be reading not the summary anymore. Oh, God. Wool, tree, sugar, trino. So, you know, that's what they're saying is they're making things out of different products, and they've got footwear, apparel. I'm surprised this is so low in the document. I had almost given up on scrolling this document until I learned they now make underwear. But these are all the different types of shoes. Their thing seems to be the carbon footprint and the water resistance there. Again, I don't know why that wasn't higher up in this document. We're just scrolling the document there. But I think I'm ready to make the... Okay, there's where their stores are. 27 stores. What's your footprint? Okay. Trying to compare themselves to all these other companies. Yeah. There's nothing here we don't already know. These are just cute graphics for the same thing. Sharing our message. I'm sorry, you can have a message if you're making money. If you're not making money, I don't want to hear your message. So yeah, you can have a message if you're making money, but if you're not making money, don't really care to hear your message. But I think now it's time that we've taken a look what's going on. Let's go back here. And just so you can kind of see how this whole thing works, Robinhood list and... Let's go ahead and get that going again. Give me a second to get the screen sharing out going again. Come on. Okay. So Robinhood lists a IPO, and we will see, you get there, you choose your shares. That's the number of shares that were available for past IPOs. You're then allocated. Total investor demand, order size doesn't really matter. Age of account doesn't really matter there. And your outlook. So it will tell you how many requests there are versus what they actually get right there. So looking at the fact that the company, now I will tell you, I played before. I put in a placeholder number. I put in 100 shares. Looking at the fact that this company is not profitable in the least bit and has no plans to make money in the future, I'm going to go with 1 share. As Randy Jackson would say from American Idol back in the day, that's a no from me, dog. I am not going to be buying Allbirds other than maybe 1 share just for the giggles to see if I get it. Up next, random allocation. So there'll be that random allocation. This is actually kind of new, which kind of shows you what actually goes on in the Robinhood IPO process. But you can find this stock if you believe different. If you are an Allbirds wearer, an Allbirds lover, or you have an Allbirds lover in your life, you can just look BIRD in Robinhood, and you'll be able to see that on the IPO access list. I think that's all it tells you. I'm interested in buying exactly 1 share just for the giggles, just for the lulz, spending no more than $14 there, maybe 16 if it goes higher. But this company's never made a profit, and it's really not something I want to hold on to. This is Richard from No Pants Profits giving you a look at the Allbirds, BIRDALLBIRDS IPO. In Robinhood. If you have any further questions, drop it in the comment below or shoot me an email at nopantsprofits@gmail.com. Have a great one. Bye.